In this, the 38th lesson in the course, A Critical History of Economic Theory and Policy, we look at the presidential administration of Barack Obama, the first person of color to be elected to this office. Among his supporters, there was great expectation that the course of history would return to a more progressive path than had been experienced for a long time. To the millions of U.S. citizens who voted for Barack Obama in 2008, his election offered hope that government would once again begin to serve the interests of the common citizen rather than corporate executives, bankers, and the moneyed elite. Some expressed frustration and concern over the people he chose to bring into the new administration. Timothy Geithner, for example, came to the Cabinet Office of Secretary of the Treasury with a good deal of controversial history. As president of the New York Federal Reserve Bank beginning in November of 2003, Timothy Geithner was one of the people most responsible for allowing the nation's financial holding companies to engage in activities that helped to bring the financial system to the brink of collapse. Alan Greenspan, by his own admission, championed the hands-off approach that allowed bankers to create new financial instruments, the risks attached to which were unknown and could not be priced for. As Greenspan later wrote, "The volume of international trade has been rising far more rapidly than real-world GDP since the end of World War II. The expansion reflects the opening up of international markets as well as major gains in communication capabilities. In order to facilitate the financing, insuring, and timiness of all that trade, the volume of cross-border transactions in financial instruments has had to rise even faster than the trade itself. Wholly new forms of finance had to be invented or developed. Credit derivatives, asset-backed securities, oil futures, and the like all make the world's trading system function far more efficiently. Given the complexity of the global trading system and the financial structures required, Greenspan concluded that regulation was considerably beyond the resources of governments. To a significant degree, parties involved had to protect their own interests by due diligence measures. The staff at the Federal Reserve fully recognized the power of counterparty surveillance as the first line of protection against overextended or inappropriate credit. Markets have become too huge, complex, and fast-moving to be the subject of 20th century supervision and regulation. No wonder that globalized financial behemoth stretches beyond the full comprehension of even the most sophisticated market participants. Financial regulators are required to oversee a system far more complex than what existed when the regulations still governing financial markets were originally written. As president of the New York Federal Reserve Bank, Timothy Geithner stated publicly that financial firms like Citigroup should be held to the highest regulatory standards. However, the record shows that the New York Fed looked the other way as Citigroup moved aggressively into the private label mortgage-backed securities business, collateralized by poorly underwritten subprime mortgages. These and other incidences of poor risk management caused the biggest bank rescue in U.S. history. William Greider wrote of Geithner in The Nation, "His easy terms protected shareholders and executives, but demanded almost nothing from the failing banks for the public. Worst of all, the deals did not work. They have failed to stabilize much of anything and are still putting Wall Street preservation ahead of the national interest. Where is the evidence that we can expect a different approach if Geithner is in charge, or even that he understands the true dimensions of this risk?" And then there is the appointment of economics professor Lawrence Summers as assistant to the president for economic policy and director of the National Economic Council. Why should this decision have been troubling? Remember that Lawrence Summers served as Secretary of the Treasury from 1999 to 2001. In one of the more controversial decisions in modern times, Summers oversaw the repeal of the Glass-Steagall Act, paving the way for consolidation of commercial and investment banking activities that resulted in the channeling of bank deposits into the derivatives market and other risky financial instruments with minimal regulatory oversight. Of the repeal of Glass-Steagall, Alan Greenspan wrote, "A few months before I took up my duties at the Fed, the board introduced a proposal that would again allow banks to sell securities through affiliates under very restrictive conditions. The board continued to encourage easing of the restrictions, and I testified many times for legislative change. It took until 1999 for Glass-Steagall to be repealed by the Gramm-Leach-Bliley Act. We dare not go back." Going back is just what Senators Elizabeth Warren and John McCain had in mind by introducing a bill in July of 2013 to redraw the line between traditional banks that hold FDIC-insured customer deposits and institutions that provide services such as investment banking, insurance, swaps, hedge fund, and private equity investments. As Treasury Secretary, Larry Summers urged Bill Clinton to sign the Commodity Futures Modernization Act that removed oversight from the credit default swaps and derivatives trading with disastrous consequences. In hindsight, Bill Clinton commented in a 2010 interview, "I think they, Rubin and Summers, were wrong, and I think I was wrong to take it because the argument on derivatives was that these things are expensive and sophisticated and only a handful of investors will buy them, and they don't need any extra protection and any extra transparency." And the flaw in that argument was that, first of all, sometimes people with a lot of money make stupid decisions and make it without transparency. And secondly, the most important flaw was even if less than 1% of the total investment community is involved in derivative exchanges, so much money was involved that if they went bad, they could affect a 100% of the investments, and indeed a 100% of the citizens in countries. Both Lawrence Summers and Timothy Geithner were protégés of Robert Rubin, who served as Secretary of the Treasury during the Clinton years in the White House. But that is not all we ought to remember about Robert Rubin. Before his government service, Rubin spent 26 years at Goldman Sachs, eventually serving as a member of the board and co-chairman from 1990 to 1992. More recently, he earned over $125 million in cash and stock from Citigroup as temporary chairman during the bailout negotiations with Treasury Secretary Timothy Geithner. Even before the Obama presidency, the Clinton legacy was carried forward by Henry Paulson, who as Secretary of the Treasury under George Bush did nothing to curb the risky mortgage lending and the private label mortgage-backed securities the banks issued. And what was Henry Paulson's job before coming into government? He was CEO of Goldman Sachs. Taking the oath of office on the 21st of January 2009, President Barack Obama raised sobering issues. Our economy is badly weakened, a consequence of greed and irresponsibility on the part of some, but also our collective failure to make hard choices and prepare the nation for a new age. We remain the most prosperous, powerful nation on earth. Our workers are no less productive than when this crisis began. Our minds are no less inventive. Our goods and services no less needed than they were last week or last month or last year. Our capacity remains undiminished, but our time of standing pat, of protecting narrow interests and putting off unpleasant decisions, that time has surely passed. From this day forward, the primary objective of Republican Party members in the Congress was openly expressed by the senator from Kentucky, Mitch McConnell. Our number one priority is to make this president a one-term president. Not end the recession or solve the problem of poverty or pay down the national debt or rebuild the middle class. No. The number one priority of the Republican Party was to oppose the president and the Democrats to assure his presidency failed. Barack Obama inherited the Bush bailout program. Yet, true to Mitch McConnell's declaration, not one Republican member of the U.S. House of Representatives voted in favor of the American Recovery and Reinvestment Act. Arlen Specter voted for the bill in the Senate, but eventually broke with the Republicans and joined the Democratic Party. The $787 billion economic stimulus package was approved by Congress in February 2009. The package was designed to quickly jumpstart economic growth and save between 900,000 and 2.3 million jobs. On the downside, there was no tax revenue to pay for these programs. The act included direct spending on infrastructure, education, health, and energy, provide federal tax incentives, expanded unemployment benefits, and other social welfare provisions. The act also included many items not directly related to immediate economic recovery, such as long-term spending projects and other items specifically included by Congress, such as the limitation on executive compensation in federally aided banks. What the Democrats could not overcome was the continued revenue shortfalls caused by the low marginal tax rates on the wealthy and on gains experienced on the sale of financial assets, gains misdescribed as capital gains. Without significant cuts in government spending, the deficit had nowhere to go but up. And by mid-September of 2009, the national debt had climbed to $11.8 trillion, growing by some $5 billion daily. One of Barack Obama's first moves was to bring together 4 experts on tax policy within an economic recovery advisory board chaired by Paul Volcker. Martin Feldstein, a former chairman of Ronald Reagan's Council of Economic Advisors, was recruited by Volcker to participate. Volcker proved to be as independent in his views as Feldstein was expected to be. In the months following his appointment, Volcker called for the nation's banks to be prohibited from owning and trading risky securities, the very practice that got the biggest ones into deep trouble in 2008. The response from the Obama administration was negative, stating that they would not support the separation of commercial banking from investment operations. Volcker responded, "People say I'm old-fashioned and banks can no longer be separated from non-bank activity. That argument brought us to where we are today." One major contribution made by Paul Volcker found its way into the broader financial regulation reform passed by the Congress in July of 2010. This measure, referred to as the Volcker Rule, restricts the ability of banks whose deposits are federally insured from trading for their own benefit. If only the Volcker Rule had stipulated that any financial institution accepting government-insured deposits would be prohibited from extending credit for the purchase of land or the acceptance of land value as collateral for any borrowing. Volcker argued that the banks should not be gambling with money guaranteed by taxpayers. Barack Obama eventually endorsed the measure, despite, or perhaps because, it was vehemently opposed by some banks and Wall Street firms. The Obama team struggled through its first year in office, but the year 2010 began with an upswing in consumer spending. However, the economy stalled once more as stimulus spending softened and the debt problems of one European government after another arose. In the United States, unemployment continued to rise in the face of rising costs of living, particularly the costs of health care. Among the great challenges facing the Obama administration in 2009 was what to do about the financial problems of Chrysler and General Motors. His team concluded that the only solution was to force both car makers into bankruptcy protection, then provide the financing necessary to reorganize on condition that both eliminated unneeded capacity and workers. Both companies emerged from bankruptcy within a few months. Chrysler, acquired by Fiat, was soon profitable, as was GM, which returned to the stock market in 2010. Early in 2009, many of the nation's property markets were continuing to lose land value. Foreclosures were continuing to rise, not only because of predatory and fraudulent subprime mortgage loans, but because of recession-caused unemployment. The dollar amount of problem loans approached $1 trillion. To the banks and other mortgage investors, including Fannie Mae and Freddie Mac, it made little sense approving refinances of mortgage loans to people who were unemployed or who had insufficient income to stay current on mortgage debt. Thus, the number of consumers who were deemed eligible for new mortgage terms was about 1 in 4 troubled homeowners. Not since the late 1920s and throughout the 1930s had the United States experienced such a perfect storm preventing sustainable economic growth. All across the United States, the private sector was engaged in creative destruction, reducing the number of employees wherever possible. Revenue shortfalls also caused layoffs and early retirement in local and state governments. Federal tax revenue was insufficient even to begin to meet the costs of rebuilding the nation's aging infrastructure. Servicing the escalating national debt siphoned off hundreds of billions of dollars annually. Thanks to actions by the Federal Reserve, the interest costs to the U.S. government have remained far lower than what might have been expected. These moves have benefited the banks and borrowers at the expense of savers. Federal Reserve Chairman Ben Bernanke, in his September 13, 2012 press conference, conveyed the Fed's planned course of action. In particular, the committee today kept the target range for the federal funds rate at 0 to 0.25% and stated that it anticipates that exceptionally low levels for the federal funds rate are likely to be warranted at least through mid-2015. Oil prices resumed an upward climb during the Obama presidency, absorbing business revenue and household incomes, offset somewhat by falling prices for natural gas. Perhaps of greatest concern to many is the continuous rising cost of medical care, challenging the financial viability of insurance carriers and individuals alike. Medical expenses are one of the leading causes of bankruptcy proceedings in the United States. In 2007, 57 million people were in families who had problems paying their medical bills. Climate change, whether caused by natural cycles or human activity, caused 2010 to be the second hottest year ever recorded, bringing an increased number of tornadoes, violent storms, floods, and expanding drought across the nation. At the end of 2010, the voters chose more Republicans over Democrats, and the Republicans became the majority party in the U.S. House of Representatives, prompting President Obama to reflect on the reasons citizens voted against his party. And yesterday's vote confirmed what I've heard from folks all across America. People are frustrated. They're deeply frustrated with the pace of our economic recovery and the opportunities that they hope for their children and their grandchildren. Faced with determined Republican opposition, particularly among newly elected Tea Party Republicans, the Obama administration needed to create strong public support for his assessment of what the economy needed. Unfortunately, his economic team could come up with no strategies that had not been tried with mixed results in the past. In 2011, Robert Reich expressed his own frustration over what he viewed as a lack of moral courage on the part of Barack Obama and others in the administration. If you widen the lens, the public is being sold a big lie that our problems owe to unions and the size of government, and not to fraud and deregulation and vast concentration of wealth. Obama's failure is that he won't challenge this Republican narrative and give people a story that helps them connect the dots and understand where we're going.